Hi, welcome to the Market Alert for Friday, the 10th of June 2016. So yesterday we had a situation where the market was trading sideways, having taken a loss of 34 points on the first trade, 31 on the second. I sent out a note saying to stand aside because the market is going sideways. The question is, why is it trading sideways? Well, the answer to that is very simple. There are two reasons for that. One, the market is news driven at the moment. And second, of course, there wasn't any news yesterday to actually move the market, and you can't have one without the other at the moment. But then you've got the Brexit thing in the background, so the currency markets are the same, and the stock market's waiting for Yellen to make a decision on interest rates this coming Wednesday. So we can expect more of the same today. You can see there the market eventually did manage to break out, but it took until towards the end of the session. We had this 50-point range, and then the market broke out. And again, you can see the 18,000 is really giving this market some grief there. If you have a look in the daily chart, you can see this even more. The market has been sideways for the last 3 days, and again, this is down to the market waiting for Yellen's decision on interest rates this coming Wednesday. News-wise, today we've got the prelim consumer sentiment. This is out at 3 p.m. This is the only news item. This is out at 3. Let's see how the market reacts to this. But we could see a fairly quiet Friday as well. So again, forewarned there, as I warned in yesterday's market alert, that it could be quiet during yesterday's session beforehand, and it turned out to be the case as well. Again, this is not unusual as the market waits for the Fed's decision on interest rates and major news. It's something we've seen for the last 8 years. But what is interesting, I'm just going to switch back. Yesterday morning, Draghi spoke in Europe at around 8:30, and the market actually moved lower because the central banks have run out of ammunition and ideas of what to do to keep these markets and the global economy going. It's just a matter of time now before we start to see things really falling apart, and it's certainly going to happen during this summer. If not, I'll be very surprised. Just back to the daily chart though, I just want to discuss my own personal opinion of what's going to happen in the next few weeks. I suspect that Yellen isn't going to raise rates. She can't do after last Friday's unemployment figures that came out, it were just dire. 156,000 new jobs, and it came out at 38,000. So she's painted herself into a corner once again where she really can't increase interest rates. If she does, the market will move lower, as I said yesterday, because that's what happened in December. And then during January and February, the markets lost 2,000 points. And this will be the same if she does increase rates this coming Wednesday. I can't see it personally that she will do it, but the biggest problem that she and the Fed have now is their credibility, because nobody believes what it is that they say, and people have come to the conclusion they don't know what they're doing either. It's taken a lot of people a long time to come to that conclusion, but from day one when they said they were going to print money, I knew the writing was on the wall for the global economy at some point down the line, and we're 8 years down the line, and that is now in the headlights. We can see what's actually going to happen. We've got negative rates, negative yields. It's impossible for the Fed to move, because when they do move and increase rates, the market collapses. So, like I say, credibility and painting themselves into a corner. That said, the market is likely to have its sort of last run at the all-time highs. Should she not raise rates, it will be a relief for the market, because if interest rates go up, people tend to take the money out of the markets, put it into banks, because they're guaranteed a rate of return. Not at these rates though, of course, but nonetheless the principle remains that and the relationship, of course, that should they not increase interest rates, the market will be relieved by this, and we will see a rally. And we're not that far off the all-time highs, as you can see from the chart here. If I just bring that down, 18,364. All we've got to do is break the 18,364 points up to those highs. Is not difficult to achieve, and then we see the market reverse and then fall for the remainder of the summer. On the implied volatility front, well, this is backing it up as well, but the market yesterday, even though it was quiet, it looks like the options traders are pricing in a risk because the implied volatility was increased to 11.7, and again you can see that in the price chart at the bottom. It's just, like I say, a matter of time, because I've never seen this so coiled and sideways in the implied volatility. So we certainly are going to see something very interesting coming very shortly, but nothing until we get next Wednesday's Fed's decision out of the way. Right, that's it for today and for this week. If there is anything to report during today's activity, I will let you know, or the lack of activity. Other than that, have a great weekend, and I will see you in Monday's Market Alert. Thanks for watching.